Last quarter, 4 companies told Wall Street they would spend $750 billion this year on infrastructure for AI. Meanwhile, Nvidia reported the other side of that ledger. 61 cents of every Nvidia dollar now comes from 4 customers. 1 year ago, it was 36. Nvidia has invested in or backstopped CoreWeave, Nebius, and OpenAI. This is the money wall. And the dollars Nvidia invests come back as Nvidia revenue. Here is how the loop works. In September of 2025, Nvidia signed a letter of intent to invest up to $100 billion in OpenAI. The money is released progressively, 1 gigawatt at a time, across at least 10 gigawatts of Nvidia systems. Nvidia is also CoreWeave's buyer of last resort. A $6.3 billion promise to buy CoreWeave's leftover capacity, filed with the SEC, runs through 2032. Nvidia owns about 12% of CoreWeave's stock. Same playbook with Nebius, $2 billion in equity. Same playbook with Lambda. Nvidia rents back 10,000 of its own chips for $1.3 billion. Same playbook with Crusoe, with Applied Digital. Then those companies borrow against the chips and the contracts. They use the money to buy more Nvidia chips. Bernstein's Stacy Rasgon called it out the day Nvidia announced the OpenAI deal. Quote, "The action will clearly fuel circular concerns." CoreWeave's CEO, Mike Intrator, was less polite. He called it, quote, "ridiculous, a fly on the back of an elephant." Jensen Huang answered the same question on a podcast that same month. Quote, "The revenue side of it has nothing to do with the investment side of it. The investment side of it is not tied to anything. It's an opportunity to invest in them." New Street Research did the math. Every $10 billion Nvidia invests in OpenAI comes back as roughly $35 billion in chip orders, 3.5 times. So that's the loop. Real, documented in filings. The question is whether the rest of the plumbing holds. Here is the part most coverage skips. The dollars in the middle pass through a brand new asset class. Debt collateralized by chips. In 22 months, Wall Street took it from junk to A-rated. In May of 2024, CoreWeave borrowed $7.5 billion from Blackstone and Magnetar, secured for the first time in finance history by Nvidia GPUs. The pricing was SOFR plus 650 basis points. In English, 6.5 percentage points above the benchmark rate banks lend to each other. Junk tier territory. It was the largest private credit deal ever signed at that moment. 22 months later, March of 2026, same company, same kind of loan, $8.5 billion, SOFR plus 225. Only 2.25 points above the benchmark. And rated A by Moody's. The first investment-grade rated GPU-backed loan in history. The borrowing cost dropped by more than 4 percentage points. Wall Street learned to lend against a chip in less than 2 years. The single load-bearing assumption underneath all of it is the useful life of the chip. CoreWeave depreciates one of its H100s over 6 years. Nebius depreciates the same chip over 4. Same hardware. 2 different versions of the truth. Bernstein says 6 years is reasonable. Intrator points at the data. The older A100s from 2020 are still fully booked in 2026. When an H100 contract expired, CoreWeave rented the chip out again at 95% of the original price. If they're right, the math holds. The pattern is the same at every neocloud. Nebius sold $4.6 billion in convertible bonds after Microsoft signed for $17.4 billion. Lambda raised $1.5 billion a week after Microsoft signed for the GB300. Crusoe got $7.1 billion from JP Morgan after Oracle signed a 15-year lease for OpenAI's Stargate site. The customer is the collateral. The next layer up is the hyperscalers. They have their own move. Meta's biggest data center is called Hyperion. The full cost, almost $30 billion, but Meta owns only 20% of it. The private credit firm Blue Owl owns the other 80%, so the debt sits on Blue Owl's books, not Meta's. Meta's biggest project barely shows up on Meta's balance sheet. Ernst & Young, Meta's auditor, flagged the structure in February. They called it a, quote, critical audit matter. Translation: this one needs a closer look. Oracle has $38 billion of similar deals. XAI has 20. Hyperscalers now spend a record 60% of their operating cash flow on Capex, Apollo's data, but they barely borrow to do it. For every dollar of their own money, only 23 cents of debt. Telecom companies in 1999 borrowed roughly 10 times more, dollar for dollar. Steven Schwarzman runs Blackstone, $150 billion of data centers. He said this on his earnings call last month, quote, "The historic pace of investment to develop AI is the key driver of economic growth today." Now, look at the customer. OpenAI's annualized revenue as of the start of this year is $20 billion. The contracts OpenAI has already signed for compute over the next 8 years total about $1.4 trillion. Sam Altman disclosed both numbers on the record in November. 70 times revenue. That is the math the loop has to deliver. Here is the version of this story that doesn't come from a short seller. Dario Amodei runs Anthropic. He is one of the people writing those compute commitments. In February, he said this, quote, "If I'm just off by a year in that rate of growth, or if the growth rate is 5 times a year instead of 10 times a year, then you go bankrupt. That's the failure mode," said by the person spending the money. There are 3 places to watch it break. 1. The chips depreciate faster than the accounting assumes. Nvidia ships a new generation every year. H100 cloud rental prices have already fallen 64 to 80% in 24 months. If the next generation makes the last one uncompetitive, the collateral on $200 billion of GPU-backed loans gets written down. 2. The neoclouds depend on a few customers. CoreWeave got 67% of last year's revenue from Microsoft. If Microsoft moves workloads onto its own data centers, CoreWeave's $18.8 billion of debt sits on thinner cash flow. 3. Revenue grows slower than the bills come due. HSBC estimates OpenAI needs another $207 billion to fund the contracts it has already signed. Stargate is already being triaged. The UK site died. Norway transferred to Microsoft. Abilene shed 600 megawatts. That is not collapse. It is the participants triaging in real time, in public. Howard Marks at Oaktree wrote The Bridge Between the Two Sides in February, quote, "Some AI revenue is currently circular in nature." And in the same memo, quote, "More money is going into inference Capex these days than training Capex." Both takes from one author in one document. The financing has weak spots. The demand is real. That's not a bubble. That's an installation phase. We have done this 3 times in the last 165 years. Railroads in the 1860s, federal bonds and shell companies. 40% of those bonds defaulted in the panic of 1873. By 1890, the rails moved 5 times the freight at a fifth of the cost. Telecom in the 1990s. Lucent extended $8 billion in vendor financing, a lot like CoreWeave today. Stock went from $84 to 58 cents. Bondholders lost 80%. The dark fiber they laid powered YouTube, Netflix, Zoom, AWS, cloud in the 2010s. AWS launched in 2006. No profit until 2015. Microsoft made the same bet on Azure and went from $300 billion to $3 trillion. Same pattern, same playbook, different substrate. Carlota Perez named it in 2002. Installation phase, turning point, deployment phase. Railroads, telecom, cloud, all 3 got built and paid off. In 2 of the 3, late investors lost most of their money, but not once did the infrastructure go unbuilt. Here are 3 things to watch by December. 2 progress, 1 stress. 1. Progress. Stargate's Abilene flagship has 2 of 8 buildings live, full 1.2 gigawatts, targeted for the third quarter of this year. Watch Crusoe and Oracle's September earnings call. 2. Also progress. CoreWeave reports Q3 around the end of August. If Microsoft drops below 55% of revenue and OpenAI activates above 15%, the contracts they signed are turning into actual revenue. If the concentration stays above 65%, watch what the lenders do next. 3. The stress signal. Microsoft, Google, Meta, Amazon report 2027 Capex guides at the end of October. Combined above $850 billion. The build-out is on track. If that number is flat or down, the build-out is slowing. Any one of them quietly cutting their 2026 budget mid-call, that's the warning. Wall 1 was power. Wall 2 was chips. Wall 3 is money. The walls are real. They are being walked across. Vendor financing isn't the problem. It's the only way to build something that pays back over 10 years, with money that wants its return in 3. Jensen knows it. Apollo knows it. Howard Marks knows it. The answer was Microsoft going from $300 billion to $3 trillion. Subscribe. There's a fourth wall coming.